Mark, let's kickstart our conversation about the markets, talk about the markets in 3 minutes, and chart the appetite for risk that we've seen over the past 24 hours, because it seemed that we were selling risk assets pre-visit, so in the run-up to the visit. Then there was some relief around the nature and extent of the response, at least in the short term, from China. But then there was a bit more of a sell-off as the House Speaker started to speak, and then something of a rally. So we've been through a lot in the past 24 hours, it seems.
I think you're right, and I think you've charted it better than I could. So I guess I'll just give some extra context of where do we go from here. And I think that's probably where we get a little bit of a divergence. I think the idea in Asia, we're trading a little bit more negatively. We're worried about that China might continue to kind of impair trade with Taiwan, which might have knock-on effects on supply chains. Remember, they're a massive supplier of semiconductor chips. They are the most important supplier of semiconductor chips. So there's a little bit of worry about whether this will kind of have rippling impacts on Asia over the weeks ahead. I think in the US, the narrative has turned more positive, and obviously they were also concerned about a bigger geopolitical markets risk event here, but we seem to have not got that tail risk event, and therefore the US can start trading a little bit more positively.
OK, let's get to the other big story, but there are some linkages between them. That is what we saw in yields yesterday, Treasury yields. They've been used, obviously, as a sort of risk aversion asset, but also responding a lot, and perhaps more so, responding a lot to what the Fed has been saying. So we saw a really big ramp up in yields yesterday. Just some of that being unwound this morning.
Yeah, look, completely. I think that, we saw a really, really massive move yesterday. And look, we've talked about this the last couple of weeks. I think that ultimately US yields need to go a lot higher. I think that the pricing for the Fed to have a dovish pivot next year is just completely illogical. So I think that ultimately yields will be much higher. What happens in the short term, I have no real conviction, but it means I'm constantly alert for that move higher, and I think it is justified. The JOLTS data disappointed yesterday, but it still shows there are a massive amount of job openings in the US. This is not a labor market that it makes sense that the economy is in recession. Earnings are good in the US. They are not showing an economy under recession. In fact, they're showing that the consumer is very, very strong. So I think the overall story for the next few months is that there will be an asymmetric risk for events to yields go much higher than for the drift lower when nothing happens.
And I suppose some of that could happen on Friday. We're going to get the jobs report. And so if we get a strong jobs report, you think, the stage is set for those yields to go back up?
I think completely. I think it'll be people to kind of really start abandoning some of those ridiculous doom-monger calls that the US growth is absolutely plummeting in deep recession already. Yes, the growth is slowing, but that is very different from being contraction. I think that's really the big distinction. And what seems to be ignored amidst all this focus on growth is that there's a massive inflation problem, which shows no hint of being under control yet. The latest CPI print was still the highest we've seen in this cycle.